Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
Welcome back to the Gentle Art of Crushing It podcast, Passive Investing Edition. My name is Randy Smith, and I am your host and also the founder of Impact Equity. And our goal here is to educate and inspire the passive investor as they continue their journey towards passively investing in real estate. We have got an awesome show with a good friend of mine, Tim Fergestad. Welcome to the show, Tim.
Thank you. Pleasure to be here.
Awesome. Well, why don't we just go ahead and jump? Actually, before we do that, I was referencing earlier how you're such a strikingly good-looking guy, and saying that it's possible that we could actually be brothers. But anyways, all joking aside, let's jump into it. Tim, why don't you go ahead and walk us through your journey to passive investing?
Sure. Well, I guess I'll start at the beginning, not with my first piggy bank exactly, but I'll say it was probably, I started investing in college in the 90s, right? And do you remember like when E-Trade was a thing?
I do, yeah.
That was exciting. And so you could go online and you could just buy your own stocks. You didn't have to go to a broker and stuff. So that was fun. But then my wife and I, well, at that time I wasn't married yet, but sort of became a professional student. I went to graduate school, got married. My wife went to graduate school as well. And ultimately I started working in a university while she was finishing her degree, and started to get a retirement plan and things like that. But we were living on debt as professional students and having a terrible financial education, just being in the biomedical sciences. There wasn't a lot of economics and so forth. And so at one point when I transitioned to a different university, I cashed out my retirement, right, and paid the penalties and stuff just because we needed the cash to keep going on. And yeah, it was sort of we're deferring, right? We're just trying to get by because someday, because we have student loan debt and all this other stuff, it was not really a big concern. And so we were starting some bad habits early on for sure. Mm-hmm. Then my next job, I was working in the genetics department at the University of Wisconsin in Madison, and doing neuroscience research. And I had some retirement funds there as well. And the standard stuff, right? Where they set it up for you and they give you an option maybe to direct it into aggressive, less aggressive or something, 80-20 or, something like that, something generic, and they put it into their products. You don't really get a say. And at that point in my life, it's probably best that I didn't have a say because I didn't know anything about it. So in that sense, I think that was nice. And I later learned more about, fiduciaries and having them having financial advisors be compensated based off of performance rather than I lose money, they still got their fee, right? They make money whether I do bad or good. That really bothers me, And
that's a really good point, Tim. I like that you brought that up because that's something we've not talked about yet on this show. But as you become more educated and more skilled and experienced in investing, kind of the guardrails start to come off a little bit, and you have less protections, but more options and potentially more aggressive options to choose as well. So yeah, thank you for bringing that up. That's a good point to reference.
Yeah. And for better or for worse, we started working with financial advisors more. And for example, when my wife was finishing her residency, the financial planners come in, right, selling disability insurance, right, and stuff like that. So now one of your biggest assets is your potential earning income potential. And if you get hurt, you lose that, right? And we have tons of student debt and other stuff. So it makes sense. But they start the relationships with you then, right, before you're even making money. And then you buy some of their products and lock that in. And it wasn't till later when we started having kids, and then we had a family, wanted some well, we'll get some life insurance now, and start realizing you have to structure things a little bit differently and start planning a little bit more. And we did that dance a couple of times. And so we got a late start, I guess I'd say too. Being professional students, it wasn't until like our mid-30s when we really started to work with a different set of financial advisors and group.
Okay.
Right? And they helped educate us a bit, and sold us some products, of course, and helped us invest our savings in retirement funds, right, according to our risk tolerances.
Yeah.
But it was always in their products, right? Or we bought like a whole life product, for example,
Yep.
for some extra insurance and stuff, which I still like. I mean, some people are pro or con for that. Depends on where you're at, right? As an investment vehicle, that actually has a lot of perks and stuff. But like,
yeah, and I'm curious. Can you share at just a high level what that model looks like? I'm going to have another guest that works in that space that's going to walk through it in detail. But if you could share kind of high level what that is as well, that'd be great.
Sure. Well, some advisors, right, are very much against that sort of stuff. They're just like, buy term and invest the rest, right? Which can be good, right? If when you're starting out, you don't have a lot, that makes more sense.
Yeah.
Right. But then as you develop and you grow your portfolio, and it starts to make more sense to own your policy, and you get a bunch of cash in there that you can access when you want. You can become your own bank, and that's also your retirement later, and you take it out tax-free later. There's a lot of benefits to it. It made sense for us, and I'm not gonna dive into that too much more. But the point is I've used it, and it's been helpful.
Yeah. Okay.
Anyway, so with those financial planners, they'd put most of the stuff back in the market, right? That's, if you ever brought up something like real estate, they'd say, "Oh, that's risky," right? Or they'd point out that like, well, the market averages 7 to 8% historically, and the real estate market's closer to 4 to 5%. Yeah. And well, that was the trend back in the day. I think if you look at the 20-year average now, it's real estate's a lot better. But anyway, one's going this way, one's going this way, right? A little bit better on on average, but they don't include the fees, right, and the volatility costs and other stuff in the market. But also, when I buy in real estate, I don't just buy a house and just sit on it and see if it goes up or down, right? There's a business plan, and there's cash flow coming from it. You rent it out and things like that. And that's basically what. And that's where you make your money on the deal. And then any of the 4 or 5% added on is just gravy, right? And so in that sense, it can be a really good asset class. And I was starting to learn that then, right?
Okay.
My wife became the breadwinner. Okay, go ahead.
Yeah, so I'm curious. Why do you think the financial advisors or the professionals out there kind of deter you or try to push you away from real estate?
They're not allowed to. They're taught and told that's called trading away. I think is the term, and they are not allowed to do that, right? Some of the best real estate investors I know used to be financial advisors, and they'll tell you all about it. That'd be a good person to have on the show, actually. But
no, I think and that's a good point. Be careful who the person is that you're talking to and where their incentives are.
Absolutely.
And where their loyalties and motivation lie. So if you're a financial planner and you're being paid based on assets under management, they don't have a way of offering real estate because that goes outside of their ability to manage those assets. So I think that's a really good point. And a lot of people don't realize that and don't take that into consideration when they're talking to their financial advisor and they try to deter them from taking a look at real estate. It was something I was baffled at for years and years and years, where I had, this rich dad mentality in the back. And actually my dad, who was a big real estate investor, saying, invest in real estate, invest in real estate, invest in real estate. And then yet everything I hear when it comes to 401k planning, financial advisors, all of the big professionals, nobody was talking about real estate. So lesson learned.
Yes. Yeah, for sure. And if you did push it, right, they'd say, well, we have some REITs. We can get you into some real estate. You can diversify your portfolio, your paper portfolio with more paper. Right. Which is the point of saying that is you're not owning the real estate. You're owning a company that owns some real estate. And you don't get the tax benefits of real estate, and frankly, you're still tied to the market. I keep some REITs just for fun. I have a couple different ones still, and I do enjoy watching them just tank when the market tanks. And whereas my other real estate investments that are not associated with the market just keep doing fine.
If there's ever a time you can enjoy seeing it tank, I guess that would be it. So
yeah,
yes,
right. That's weird.
Yeah,
but no, it's not that much money in there, thankfully. But I keep them just like, kind of for fun, but just as my own metric, right? To see, I can look back and say, the properties are doing well. I've looked at some of the areas in the market some of those REITs are focused on, and rents are up, but China went into lockdown. So so now those properties aren't worth anything, supposedly. Right.
Funny.
Anyway.
Yeah. Okay. So you've been playing in all kinds of different types of investments. You've had financial advisors. You started getting this idea that maybe real estate could be a beneficial path to pursue. You had some insurance options. It sounds like you've almost been the victim of really good salespeople over the years until you started to shift away from that.
Oh, wait, I bought more stuff. Hang on.
Okay.
So I got more into real estate, and I started to, it was something I could do on a more flexible schedule, right? Because my wife became the breadwinner, and I pivoted and started doing more real estate, which is something I could do on a more flexible schedule. And I wanted to flip and hold my own plexes and stuff. And it doesn't take long to realize that that's a job. That's not an investment. The amount of time you're spending, and as soon as you stop doing it, you stop making money, right? Flipping and things. And so it wasn't what I was looking for exactly. It was something flexible, and I enjoyed it, and I like that stuff. But I ended up getting single family rentals in different markets and hiring different people to manage them, right? Third party management and stuff. And so I was learning a lot about real estate investments and stuff during this time. And that's when I did my first syndications. I was a limited partner in other people's deals, and just sort of trying it out, some minimum investment in this one, a little more in the next one, and watching and learning and stuff. And those started to outperform my active stuff. Okay. That was very eye-opening. And I was like, why am I bothering with this stuff when I can make, great returns with zero headache, right? And so that's when the light bulb started to go on for me. And then also about that time is my wife's practice. They had private equity, which is getting into everything nowadays. They sold their practice. And so that was a boom, an influx of cash, right? And we could roll over savings, some more savings that we had. And that's when I started to realize, so we set up some 529s for the kids, and that's in the market. And I bought an annuity. There was another purchase, right? Because if I'm going to do some of these other investments, which are so risky, right? I might as well have something that's guaranteed, right? And so I bought an annuity product, and which years later I've sold, because the returns were, even when the market was booming, way less than I could have done if I'd have done an indexed fund or something, just basic.
Sure.
And which I know it's hedged, but anyway, long story short, I started doing more investments through retirement funds. I started up a self-directed IRAs, for example. Okay. And I bought some rent, and I bought some of my single family rental products through retirement funds, right? Set up a self-directed IRA, had the custodians, learned about that stuff. And that was good. It wasn't great, but it was okay. Like I said, even though you have third-party management, right, you have to sort of manage them and manage the custodians, and there's all these fees and all this other BS, which became really annoying. It again made me think the syndications were amazing, because I didn't have to do any of that stuff. It was you get a report once in a while, and somebody else is doing all the work. Anyway, so obviously I'm a big fan. But so then I learned you could invest in syndications with your retirement funds. And so then I did some of that. And then I learned a little bit more about some of the game. There's some part of UBIT called the unrelated debt financing income tax. And so some of that can get some tax on it, but it depends upon the leverage associated with it. And so I was like, I don't like the idea of paying tax in my IRA. I thought that was kind of annoying. So I found out that you didn't have to, depending upon how they do some of the loss allocations and stuff. But for the most part, if I invested in a self-directed IRA, there'd still be a little bit of tax I'd have to pay on over a certain amount of the leverage used. Or with a solo 401k, I did not. So I have self-directed IRAs and I've used those to invest in real estate, but I also have solo 401ks that I use to invest in syndications as well.
Okay. So you've used many different types of tools. You've kind of dipped your toe in, it sounds like most of the same things that I have as well. And you've just got just a flurry of experience in different areas. So you're working on this path. You've got all these different buckets that you're working in. Finally, you arrive at this syndication space. And it sounds like, the waters part, the bright lights shine down, and the beauty of syndication shows up. So talk to me, if you can, about what it is that you like most about the syndication model and passively investing in real estate through that model.
Yeah, syndications are where it's at. Better returns, less risk.
Drop the mic. That's it. We're done.
Right?
Yeah.
There's tax benefits too, right? And they can cash flow. Depends on where you're at, right? And so, circling back to financial advisors, they not often. I mean, if you're really trying to plan with some of them, they'll go to something called the 4% rule. And if people aren't familiar with that, it's basically it's a rule of how much do you need, or how much money you need to live off of 4% and not dwindle down your savings, right? So you can basically stay retired, indefinitely. You don't know how long you're going to live, how long you're going to need it. That's a conservative number. If the market averages 7%, some years it'll be higher, some years it'll be lower. 4% should be enough where you won't dwindle down your savings and run out of money during retirement. So that's kind of, what's your number, right? That's what the financial advisor would say, and that's based off of the 4% rule, right? And so, I need $4 million to be able to retire at the, where 4% of that is enough to give me what I need to live the lifestyle I want to live in retirement.
Okay, so in that example, just for the listener who may not understand what the 4% rule is, if your nest egg is a certain dollar amount and you can live off of 4% of that, we're assuming that you should be able to get at least an average of 4% from this point going forward. So if you had $1 million sitting in the bank, you are earning 4%, you're going to make $40,000 per year. Some years it's going to be a little more, some years it's going to be a little less, but you could live on that 40 grand and your principal should never decrease below that $1 million, right?
Right.
Okay. Yep. So I'm curious what your thoughts are about the 4% rule. Do you feel like that's a good number still today? Do you think it should be higher than that or lower than that? Or what type of variables do you think impact what percentage maybe you should be looking at? That's kind of a loaded question, but that's a big question, right? Because if you could really get an 8% rule, then all of a sudden your bucket's much smaller.
You can retire twice as early.
Exactly.
Right.
So I'm curious your thoughts on that.
Yeah. That's it. Right. So it depends on your strategy and the returns you're getting and stuff. Most people like myself are in the growth phase of their savings and stuff in their life. And so I prefer to take investments that are riskier, that have a better return. But a lot of people, once they have their nest egg, they don't want to lose it. So they go into retention phase where they're willing to take less returns for less risk. And so on a lot of deals right now, you can get cash flow. You can get money out of your real estate investments and the cash flow, and you can live off that cash flow. But also on a lot of these deals, when you sell that deal, you want to put it into the next deal, bigger deal and stuff, you have proceeds, or you got even more earnings from that, and you can put it into a bigger deal, which gives you bigger cash flow moving forward. And that's still growth phase, right? Because so you have to do the math and factor in what you need and what you're shooting for moving forward. But there are some deals out there, for example, that'll give you a 10% preferred return or 12% preferred return, but no upside at sale. That's still 3 times better than the 4% rule, by the way.
Yeah.
So and that's kind of my play is I want to grow up to a certain point where I can start transitioning into more of those types of deals where I get preferred return. I'm first to be paid. It's the least riskiest part of the deal, or as an investor, or as part of the capital stack in that sense. But I'm not going to get a lot of growth on it for the next deal per se. But and then there's hybrids, right? There's some where I'll take an 8%, but then I don't get anything after 10 or 12. There's different models, but that's
Okay.
sort of my goal. And being late to the game again, kind of starting a little late. Those sort of exit strategies are something I'm thinking about more and more.
Yeah, no, good. Really, really good point. And it's a similar path to what I've gone down as well. I was the high income W-2 guy. I was solely in the growth phase where I wanted to grow my bucket as fast as I could. I was less concerned about the cash flow on a monthly basis.
Right.
But then when I get the nod from upper management that, Randy, you don't have to go home, but you can't stay here one more time after 10 years with an organization. I overnight became a cash flow investor. So it was very, very important that we shift our strategy slightly. So the goal in this podcast is not necessarily to tell you what type of an investor you should be, but just to know what type you are. And, I hear that question over and over and over again, what type of an investor you are. And when I first got started, I didn't even know what type of investor I was.
Right.
So I wanted this education and these type of discussions to help me make those type of decisions. So it sounds like you were a growth investor. It's possible you could be shifting more to ultimately the exit strategy of being a cash flow investor on the backside after your bucket's big enough.
Right.
Are there any particular niches, or let's do this? What is your passive portfolio look like today? How many operators, how many deals are you in, different asset classes, that type of information? And don't talk numbers, obviously, but
okay. Well, I've been in over a dozen syndications as an investor, and I've done more developments lately. I'm a big fan of multifamily, right? I almost did a self-storage deal earlier this year. I like those. It depends on the market and things like that for all these deals, obviously. But the prices of some of these products, a lot of the older units, they make money. The numbers make sense, but it's hard to want to pay a premium for an old C-class 1960s vintage property when I can build for almost the same price. So I started investing more in developments as well, which developments can have more risk. There's holding costs, delays, and other stuff. And thankfully, they've all done pretty well, even through COVID. So in that sense, I've done a mix, A class, B class, C class, value add, but I'm largely focusing on value add.
Okay. Yeah. And I think that's a good point. I've not played in the development space myself, but I'm intrigued by it. It is important to note with development, quite often there's no disbursements until the asset is fully built and funded. So there's a long runway before you get any type of cash. So if you're a cash flow investor, it's probably important not to have a large portion of your assets sitting in development, but might make sense to have a small portion for the significant upside that can provide. So
and that's the same with the heavy value adds, right? They don't have a lot of cash flow often in the first year or so because you're still doing the work, you're still increasing the income. That's going to be your cash flow.
Okay. Well, I feel like we could talk literally for another hour here, but I want to be respectful of everybody's time. And I know we have some other important things that we want to discuss, but I'm curious with everything you've done, it sounds like you are an avid reader and educator, and you do a lot of research on things. I'm curious, what type of resources, educational content, what type of things have you gone to and leaned on to learn everything you have in this space?
Oh gosh, I'm this. I like the internet's huge. Podcasts have been great. YouTube's been great. I guess I like audiobooks is a big one.
Okay.
I mean, I think
any particular audiobooks that jump out?
Well, it started with the Little Purple Bible by Kiyosaki, and then there's so many. I'm sorry, it's hard to know. I guess just for listeners, if they're in the mindset of growing things slowly and passive income and stuff, Jeff Olson's book, The Slight Edge, it's not necessarily about finances per se, but it's about everything. It's about the little things that add up in the long run, right?
Okay.
Kind of like Atomic Habits by James Clear and some other very good books that I've really enjoyed.
Okay, fantastic. Um, let's see here. So why don't we do this if we can? I know you are involved in the active space as well within multifamily. Um, I brought you on the podcast initially just because you've had so much experience and you're just extremely bright guy in the real estate or in investing space. But I'd love to hear a little bit about what you're doing to move from the passive side over to the active now that you've really kind of had the peek behind the curtains and you're getting more involved
Right.
with the business aspect of it. So
Right.
what are you doing there?
Okay, thank you. I enjoy real estate. I like this stuff, and I'm always happy to talk about it. But I do like to do it. And I started a couple of years ago, realizing that I didn't want to spend my time on my other endeavors, being an agent here locally and trying to do my own flips and flex rentals and stuff. And I have one single family rental left in Indianapolis. But
Okay.
yeah, I'm focused. I decided actively a couple of years ago to start focusing on multifamily. And currently I have 3 deals we're raising for. One's an A class in Dallas, which is more like a yield play we were talking about, right? It's already stabilized. It's doing well. We actually closed on that, but we're still raising for that one after closing. So there's still some openings on that one. I have a one that's a combination in Nashville coming up, which is a physical value add where we can go in and renovate all the units. It's a B class, 25 years old, built in 95, 96, very nice. We're gonna renovate those units, and I enjoy that, but also make the property better. That's what I like. I like the value adds. I like to go in and make things better, help it make the residents better, make the investment better for make everybody everybody happy. I like
Yeah.
physically seeing the difference, right? I mean, it's a gated property where the gate hasn't worked for over a year, right? There's things like that are just, I'm eager to get in there and fix that and make that better. So
Yeah. So you guys are coming in, you're bringing investor capital, you're going to actually improve this specific apartment complex. So the quality of life for the tenants will improve dramatically.
Yep.
And it won't be run by a slumlord anymore. Not that it necessarily was, but you
they
guys
checked out for sure.
They did. Okay. And I think that's an important thing to share is we've talked a lot about the value add space. 9 times out of 10, it's a tired landlord, or it's a tired owner that,
Right.
maybe they're in their twilight years and they want to step out of this. They just don't have the time and energy to put into it. So in walks Tim and team with the capital and the wherewithal and the know-how to make this a better asset. And you guys you do some amazing things out there. I've seen these decks. They're beautiful properties.
Thank
so
you. Yeah,
yeah,
there's some
absolutely.
good ones. And we have one more deal. It's also B class in Atlanta. So it's very nice, 208 units. It's in the path of progress stuff on Atlanta's booming, Nashville's booming, right? Dallas is booming. These are all great markets with great assets and great operators. So I'm excited for all that.
So tell me this then, like one final question here before we certainly find out how folks can find you. There's a lot of folks in the space that are, there's just a lot of real estate deals that are going on. What does Tim bring to the table where that gives you kind of your secret sauce that you're going to bring more value to the table than maybe some of the other players that are out there? And this is me putting you on the spot. I apologize for that, but that's the question that always comes up.
Sure. Well, I think it's my attention to detail, right? I'm a nerd. I'm a geek. I'm very analytical, and so when people want details like that they're afraid to ask or something, I'm usually giving them too much. I think I'm all about sharing and keeping everybody informed, and my wife is eager for me to find other people to talk to about this stuff.
Yeah, no, that's a really, really great point. Like this business is not built for the guys that want to come in and shake a couple of hands and run off and move on to the next deal. It's a lot of time and energy and effort. And knowing you for the time that I have, Tim, and being a neuroscientist, I would hope that you have an attention to detail, which I'm sure you have. But very, very good. So if our listeners would like to reach out to you, what's the best way to reach you, Tim, to talk about some of these deals or future deals?
Yeah, be my friend. Find me on Facebook or connect with me on LinkedIn, or find our website at oakstreetassets.com. Those are the easiest ways.
Fantastic. Well, Tim, thank you so much for being on the podcast today. You've brought just a tremendous amount of value. I love all the work that you're doing out there. I love seeing you, like everywhere I go, it seems like you're there or just leaving or just getting there. So super fun interacting with you in this space. And to all of our listeners, what I would say is reach out to Tim, try to connect with both of us and continue this path. Passive investing in real estate is really a game changer. So jump on board, dig in, do the research, and make a decision to invest in your first deal. Because once you do, I promise you'll never go back. So thank you, everyone, for joining. Tim, thanks for being here.
Thank you for having me.
Absolutely. We look forward to the next time.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.